Hello and welcome to Mindful Money. I'm John Lappin, editor of Mindful Money, and today we're talking to Shaun Richards, the independent economist who provides us with daily analysis of economics. Hello, Shaun.
Hi.
Now, Shaun, I'd like to get your view of what you think the European Central Bank is doing at the moment and how it's going right, maybe, and how it's going wrong.
Firstly, it has a very, very difficult job because the political class in Europe have, in effect, given it a hospital pass, for rugby fans, of a position where a lot of this they should be doing, and they've given it to the central bank. It's trying its best to fulfil its mandate and cover up some of the grounds that they've left for it, but it has an extraordinarily difficult job. So it's failing, but not all of it is its fault.
Could it change its policy to be a more successful one, sort of under the current setup?
Possibly, but if we park for one moment the individual position right now that the sort of political class in Europe are not helping it very much, there's the fundamental problem of having 18 nations that in many respects turned out to be so different. The hopes of convergence when the Euro project was started have turned in economics terms to divergence. And when you're a central bank, that's very difficult. How do you set things for still relatively booming Germany, but also collapsing Greece, Cyprus, Portugal? In fact, in the bigger countries, the one that's probably the biggest worry to them right now is Italy.
Would the implication of your opinion be that the euro has to split in some way?
There are alternative routes for this, for countries to leave, which I recommended, and recently I recommended by far the best course in my opinion would be for Greece to leave. Others too could go individually. I wrote just over a year ago a suggestion that you could have something like 3 euros of different exchange rates for different groups of countries. As to how well that would work, places like France actually have slipped backwards, so that's not so easy either. The more radical move of fixing this would be for Germany to leave, but I don't see much hope of that actually happening.
So the big fear of a lot of economists and a lot of market analysts is that if that breaks, that will cause an awful lot of problems. They would say it would be Lehman's multiplied by many times. Do you not think that's the big risk?
No, I don't see that as big a deal as people would argue. It's fear of the unknown. Yes, there'd be disturbance. Yes, there'd be upset. But certain things would settle down. Some of these things would settle down to what places might not like. For example, a new German Deutschmark would immediately shoot up like the Swiss franc was doing up to when they capped it a couple of years ago. So that would pose a lot of questions for Germany. But then the remaining 17 as it is now would find that the new value of the euro would be a lot lower and a lot more comfortable for them. So if you think 16 winners and 1 losers is an enormous disturbance, well, actually I'd say that'd be for the better.
So what can individual countries do? So you've talked about the countries that are not doing so well. There's obviously Greece and Cyprus, but there are others as well, and there's Italy and even a debate about where France is. Now, perhaps not go through each individual country, but what can a peripheral European country do given the current situation? Or is
I think if we look at this fundamentally, one of the problems here is that these countries have problems around bureaucracy and lack of reform, onto which they've imposed a structure, a sort of federalist European structure, that has what? Bureaucracy and lack of reform in itself. So the actual mechanism here, to my mind, is taking them further away rather than nearer a solution.
Okay, now we want to talk about America as well. So by comparison, does that other central bank, the Federal Reserve, is it doing better than the ECB?
So far, I think so. But they're consequences of what the Federal Reserve's done to which we don't know. So it's like saying someone's 1-0 up, 60 minutes into a football match. There's 30 minutes to go. And by the way, I don't know that the credit crunch is going to be the equivalent of another 30 minutes. That's an illustration.
Okay, so the big thing that everyone in the market's worried about at the moment is the exit from quantitative easing. The jobs data, the recent jobs data looks a lot better from the States, so the speculation is increasing again. So we're looking like tapering's going to happen in some form at some stage. We're not going to put dates on it or anything like that, but what's your analysis of what might happen when it begins?
Well, I think one's got to be careful here because this isn't an exit from quantitative easing. It's merely slowing the pace at which it's being applied, which is quite different. And we've seen over the last few months, perhaps a little more than that, 6 months, the sort of disturbance in some markets that people are afraid of from a euro breakup, and yet suddenly it doesn't seem to bother them in this area, where for areas that I follow, long-term interest rate bond yields have moved quite a bit in 2013 from where they started. So there's a lot of problems posed there, and it's also my opinion with the likely new chairman of the Federal Reserve, Janet Yellen, not absolutely guaranteed, but seems very likely, that she, on her track record, is likely to move to easier policies. So I think that tapering has moved away, actually, rather than nearer. When it will happen, everybody was absolutely certain it was going to happen 2 or 3 months ago, and it didn't. So that area is a bit of a mess, but what it really does indicate is how difficult countries are going to find themselves to turn themselves away from a junkie culture, sugar hit culture, sugar dependency, whichever phrase you want to do to cover it. It's a big problem because you see the trouble caused by even thinking of turning the tap down a little, let alone turning it off or even taking the plug out.
Okay, now you've written about the fact that we've got into this without necessarily thinking about how to get out of it. But is there a way to do it so it's a little bit easier on everyone? Is there an approach that could make the exit from quantitative easing easier, or is it simply you've got to take the pain?
It depends on how circumstances play out. They were hoping, in my opinion, that things now would be better than they are, and they'd have a sequence of events that would make it easier to take it out. Unfortunately for them, but particularly unfortunate for the rest of us, that isn't the way things have turned out. And that's why the problems of the last 6 months over the question of tapering have been caused. They were hoping, and this was the plan, such as it was, that by the time they came to do this, things were better. For example, if we went into that alternate universe, they'd be expecting to take losses on their holdings now, but everything would be picking up and no one would care, is to paraphrase the rough idea of it. What's happened is that the future hasn't remotely turned out as they either expected or hoped.
Okay, so what do you think is the true picture in the US? You've had a few issues maybe you've had some issues with some of the data around employment and how it's being measured and unemployment as well. So what do you think the true economic picture is in the US?
That's very difficult. It's hard to say. I follow a measure that they have for underemployment, which includes things like short hours working, part-time employment. And you see that remains just under 14% right now, which is still quite high. They've had issues with how you count the numbers, so we've got a lot less certain that things have got better. Seems that more people have been employed, but there are also more people living there. So the whole situation is not as clear-cut. If you look at wages, a lot of people are, yes, getting back to work, but quite often at lower wages than before. So the whole net effect, if we try and put that together, makes you at the end of it a lot less certain that things are getting better as fast as we're being told.
Now, big challenges obviously facing central banks, facing really everybody on the planet as we change economic direction because of decisions we've already made in the last 5 years. Is there anything you think savers and investors could be doing at the moment to make it easier on themselves?
I think that tactically, something that people didn't think of before was that you now need to be careful of where you put your money. In terms of, like, say, in the UK, there was a sort of blind full obedience, however you want to put it, that all banks were safe. An implication that all banks are equal. That's certainly no longer true. Perhaps the clearest case of that is, I think it was only last year that the Co-op Bank has won, the title of the most ethical bank in the UK. I think it might also have won the most ethical bank in Europe. I could be wrong in that bit. But this year, to all intents and purposes, it's collapsed and has had to run round for other funding, or the Bank of England would have had to have stepped in. So that shows that there are risks everywhere. That's the change, I think, for savers to be aware of that.
Thank you, Shaun, for talking to Mindful Money today.